You're listening to the Best Advice Podcast, guys. If you haven't already, give us a 5-star review and help spread the word. And if you have a question for the guys, email a voice recording to podcast@bestadvicepodcastguys.com. That's podcast@bestadvicepodcastguys.com. Today's episode is brought to you by Security Financial Management. If you're ready to level up your financial game, SFM offers a free initial consultation after each episode. Just send an email to podcast@bestadvicepodcastguys.com with the subject line complimentary consultation to book yours today.
Ooh, welcome back to Best Advice Podcast, guys. I'm your host, Rob Lovaglio, here as always with Mitch Walk, Frank Lovaglio, and Austin Jacks, a.k.a. The Fats. Gentlemen, what's crack-a-lackin'?
There it is, crack-a-lackin'. Frank, do you have anything good?
I do. I actually have something good.
Well, I know you should.
Every time I hear crack-a-lack, I know I just like it. It makes me laugh. It gets me fired up for the day, right, Austin Jacks?
Let's crack-a-lackin', Frank.
Per usual, we begin our episodes with the powerful practice of positive thinking, and we like to call this "Give Me Something Good." So, Dad, give me something good.
Give me all you got. All right. Well, we got to talk a little bit about the Magic, right? It's been a while. We were kind of researching it yesterday. I think it's been since the COVID bubble, 2020, since they've been in the playoffs. People sort of forgot about the whole bubble thing because it was just the coaches and the players and significant others. So people kind of brush over that year. It's been another probably 8 years before that. But it's exciting for the city. And I was able to get tickets to Game 6. So Rob and a couple of us will be going. You guys are not going, by the way?
No, I'm not going.
Thank you.
Sorry, that's very nice of me. But
I used to go in the teams, we had Shaq and Penny and Tracy McGrady and Horace Grant, the goggle man.
Yeah.
Oh, Tracy McGrady.
Those are great games,
remember your,
great days.
Usernames, like when you're on AOL, like you didn't have phones, right? You were kids, so you have an AOL username. Mine was the next T-Mac 101. I was obsessed with them.
I don't think they had usernames, Rob. A little old for that.
Yeah, I guess you guys didn't have usernames.
The only problem with Rob is the athleticism between him and Tracy were markedly different.
Yeah.
And there was no next T-Mac for Rob.
No.
Hence he's doing the show with it.
That was close.
But it's fun, and I think it's good for the city, and just a little buzz around them. They're kind of young, fun team, right?
Yeah, up and coming team. They got those two kids from Germany.
That's kind of fun. The brothers,
Wagner
right?
brothers.
Yeah.
That's kind of cool. And
Yeah.
really young, a lot of energy, so fun to watch.
Yeah, Game 6 is, I guess, tonight in Cleveland, or 5 is tonight in Cleveland. 6 is home.
When you're going to the game because you have tickets.
Yeah, I have tickets.
Right.
You're not coming, man.
Yes, but Austin, he promised us. But that's okay.
Yeah, maybe next year.
Next year.
Yeah, it's taken a while to kind of build back our program. Remember, we had Dwight Howard, Rashard Lewis, we had Turkaloo. That was like our big. That was our squad, and we got to the championship, and then we built that beautiful stadium for Dwight Howard to stay, and then he left and went to the Lakers, and then we just kind of hit the bottom.
He never really did what they thought he'd do at L.A. either. Shaq did, but Howard. Who I really respect, and we'll talk for another minute and move on. But the Greek Freak, when he was renewing his contract, I remember because I did a documentary. If anyone hasn't seen the documentary, it's fantastic on the Greek Freak. And our original hometown guy, Doc Rivers, coaches that team now, which is fun. And Rob and Austin, his son, are great friends, and they're family friends. So it's exciting to watch the Bucks. But when you watch that documentary, it talks about his life, the Greek Freak I'm talking about, and what a cool, humble guy. My point there is when he was ready to renew his contract, they just won a championship, and he was the MVP. He was the hottest thing in the NBA. Could have gone anywhere, New York, L.A., all the big glamorous cities. And what he said was, and it was really cool, a story about humility, is he's like, you guys brought me when no one really knew who I was, and you trusted me and paid me when I was nobody. Now that I've got an opportunity to go anywhere I want, I'm going to stick with the dog that brung me here, and I want to give back to the team that gave to me. And it kind of gives me chills because I just love a guy I love humility, and so that's just kind of cool.
That's awesome,
and
I love
we'll
that,
move on from that, but go watch the documentary. It's awesome.
That's actually perfect for Give Me Something Good.
Yeah,
awesome.
It is. All right,
so let's move on to the question of the day. Today's question comes from Colin from Orlando as well. Colin, what you got for us?
You want to say something?
Hey, gentlemen, with interest rates at some of the highest levels in the past 20 years, should I keep my funds in a high-yield savings account or lock them up in a bank CD for a year or maybe a Treasury Bond? Just looking for some options. Thanks.
All right, thanks, Colin, and what a great question. Full disclosure, we at SFM are big believers in diversification and rarely advocate for an all-in-one strategy, right? So we have T-bills, we have CDs, and we have high-yield savings accounts, so we're going to let the experts all talk briefly about one of those. Mitch, you want to touch on Treasury bills for us real quick?
Of course. First of all, Treasury bills are issued by the U.S. government, the U.S. Treasury.
Right.
And there are different durations, meaning maturities. You know, you hear every day when you turn on, if you listen to CNBC or Business News, you normally just use the 10-year Treasury. That's one of the benchmarks that most people discuss and talk about.
What is that right now? What's the 10-year Treasury?
The 10-year right now is 4.66 this morning, as of, I guess, April 30th. But it has gone up significantly. You know, before the Fed started raising rates, it was in the ones a few years ago, which was not normal. It was way off the chart on the low.
It was so low.
It's very, very low. And then prior to that, a few months ago, probably now about 6 months ago, it was in the low to mid threes, and then it broke 4%. And you know, it's very interesting because a lot of businesses, housing developers, their loans are all tied to the 10-year Treasury.
Right.
So it's costing them more money to get loans right now. And in 2025, this is a concern. Why? What? Not? You know, everybody talks about the Fed lowering rates, which I think they should.
Right.
But what people don't realize, the 10-year Treasury is affected as well.
Is there a tranche coming due? You know, you hear
Yeah.
about some of the corporations with concerns because you had that cheap money, but isn't there a tranche of higher yields coming down the road?
That's the big concern,
Yeah.
Frank. What's
Yeah.
happening in 2025
Okay,
and
25.
2026, a lot of these corporate loans are 5-year loans.
And they're ready to
so
mature.
if you go 2021, right after the pandemic, 5 years would be 2026, and then some others came out in 2022. So 2026 and 25. So that's a concern that no one really has been talking
Yeah.
about. I'm glad you brought it up.
Yeah.
But there are two big tranches coming up, and companies are worried about that and concerned, and that's why there's so much pressure for the Fed to lower rates in addition, because that could affect corporate profits.
Yeah, that makes sense.
But if you're retired and you're saving your money and you're living on your fixed income, to the flip side, these are some of the greatest times we've ever seen.
In years since you get 5%.
5%. And as we're going to talk about, you're going to see high yield savings. You're going to talk about CDs.
Right.
Right now, what I like, in addition, I really like locking in the Treasury bills because they're short-term, long-term. You can sell them. There's no penalty to get out. And, you know, they're backed by full faith and credit of the United States government, unlike a CD, which you have FDIC insurance, so you've got limits on that.
Right.
And the federal government is the one who's backing up that FDIC insurance anyway, Federal Deposit Insurance Company.
Same entity backing it up.
Now, as we were talking, you normally get an inverted yield curve when a recession is coming. It happens most of the time, not all the time.
Yeah.
We still don't know. The jury's still out on whether we're going to have that recession or not. I don't know.
We've been talking about it for years. I'm hoping we can sidestep it.
August of 22 is when this whole inverted yield curve started.
Yeah.
But right now, you can lock in for 3 months if you just want a 3-month Treasury bill. As of April 30th, it's 5.39%. Now, I want to make sure I'm going to put that asterisk there because banks put it there when they give you CD rates, but they never tell you what that annual percentage rate is. That's if you hold it for 12 months.
Right, for the whole term.
Right. So a 3-month CD or 3-month Treasury bill is 5.39. So you get 3 months worth of that interest based on a 12-month annual rate.
A quarter of that yield.
Yes.
Yeah.
A 6-month you could lock in right now at 5.36, 5.36, and even a 1-year Treasury bill is locking in at 5.2%.
We haven't seen those kind of numbers for,
we haven't
10
seen
years,
them in
right?
years and years
so
and years.
long.
Now, the good news is the difference between a Treasury bill and what you both are going to be talking about is they don't pay interest. You buy them at a discount.
And
so
at the end,
you get the full amount. But every day, they are worth a little more. They accrue, but you could sell at any time and take out profit and just sell them. So really quick, for example, then I'll move on. If you buy a T-bill and it's paying just, let's make it simple math, 5%, it's $100,000. You're going to buy it for, $95,000. But every day it gets closer to that maturity. If it's even a year out, each day it'll go up a little more, And say 6 months in, you really need some money or you want some money back. It's going to be worth half of that 5% because you've held it for 6 months. It's going to be worth $97,500.
Okay.
So it's very liquid, guaranteed by the federal government, issued by the government. And because it's liquid, if you needed to take some of it out, you could. If you need to take all of it out, you could. And it goes up a little pretty much every day as it gets closer to maturity, which the day you buy it, the next day it's a day closer to that maturity, whether it's 3, 6, or 1 year.
Beautiful. Oh, Mr. Fats, you want to start us off on the T-bills?
The thing about Fats is, despite all the talk, the man responds to challenge. He never loses his confidence.
Yeah, so kind of similar, but in a little bit different vein, is the high-yield savings account, which is offered by different financial institutions. That's more just liquid cash. Because interest rates are elevated at the highest levels we've seen in a while, banks are actually giving you a favorable yield on that money market type account. Depending on which bank that you're using, we see anywhere from 4.25 up to 5% and maybe above 5% at times. Now, because this is a high-yield savings account rate, it's not locked in for a set term. It can fluctuate. It's a variable rate. So if the Fed came back and, Mitch, like you said, hopefully lowers interest rates, those high-yield savings account rates will take effect almost immediately because the banks realize that they can't lock in their own rates for a longer period of time. So it's going to fluctuate with what the Federal Reserve decides to do with underlying interest rates.
That makes sense. And that's something that if you get a high yield, so you can write a check against it. So in your brokerage account, you can get good interest. And if you say, hey, I got a down payment for a home or something, you write a check. So it's completely liquid daily, and you can write a check against it.
And lastly, let's go to my dad for the CDs. I think you have a case study, so this one should be good.
What I want to talk about, just to kind of round out all three of us with kind of a similar concept, this is a little different. This would be, we were just working with a client yesterday, and I thought it was appropriate to discuss. This is actually a CD alternative. It's not a CD, so it's not FDIC or it's not backed by the Treasury or any government entity. It's backed by an insurance company. And basically what it is an interesting product, and it came into play because we had a high net worth client that was making right around $205,000, $206,000 of income a year under MAGA. MAGA is modified income plus a few items. Tax-free municipal bonds, any foreign income would be added to AGI, and they call it MAGI just to keep it nice and complicated. But bottom line, if you have $206,000 or less, your actual Part B for Medicare is going to be $174 a month. But if you make $1 more than $206,000, it shoots up to $244 a month. So this client had about a $200,000 income, and one of the partners that's wasn't available, Dave Allen, who's been on the show, is meeting with a client right now. We were like, how are we going to solve this problem? He's really worried about this additional, because you're in a fixed income, $244 versus $174 is different. So what we did is we came up with a multi-year guaranteed annuity contract. It acts and smells like a CD. It doesn't have the FDIC. You could lock in for 3 or 5 years. There's no penalties once you hit that period. So the 5-year rate is 5.65%, and that's guaranteed for 5 years. What's cool about this in this situation, we work individually with each client's need, is because it's tax deferred, you don't pay any income tax on that. So he was putting $500,000 in this example, and for 5 years it's not included in your MAGA, and therefore is that MAGA like Trump, or is that modified adjusted gross income?
It's an I at the end, not an A.
Maggie.
So we got Maggie. Hey, bottom line is it's more taxes. But in this situation, that we stayed within $206,000 because we deferred it rather than paying it out like a CD or a Treasury does, and we got around that, and he only had to pay $174 to Part B Medicaid. So just a strategy.
And it's tax deferred, like you said, so he doesn't have to pay the income. And also, I think those rates are more favorable than some of the CDs that we see out there. CDs are great, but like you said, 5.65 on the multi-year guarantee annuity versus right now 5-year CDs are around 4.5.
Exactly.
So that's almost
another 100 basis points
per year.
And you lock it up for 5 years at tax deferral, no tax. So kind of neat, and that's what we do at Art Security Financial Management. Is every situation is different. And in this particular situation, a multi-year guaranteed annuity was better because he had to stay under that 206. So
and it works. And there are different options, and that's why. It can get confusing for people.
Really?
And that's
even
why
that we tease about MAG, but think about adjusted gross income. Now you got modified adjusted gross income. And they throw in a couple other items to kick you up, right?
Yep.
Do you know what those items are? I think it's foreign income tax. I think tax-free munis are included.
Yeah, I think tax-free
munis. I think there's one more.
And we can, people can check with their CPA or tax professionals. But again, Frank, that's and Austin, that's why we're here and we do what we do. There's so many options out there. It's extremely confusing for so many people. This is our day jobs. We study this. That's why we're here. We study it. We try to figure out what the best options are, what the options are. Try to read all this stuff. People don't understand it because it's very, very difficult, complicated. There's stuff that I don't know because I can't fix a car. I don't know any of that stuff. Don't call me if the toilet's backed up. Get a plumber. But I can't. I have no skills that way. But what we do, we found what our skills are, and we study this every day, and we look at the options. And that's what I'm saying. There's a lot of different options out here and choices for clients and for people, and they can just talk to us about it because we're not going to not talk about it. We're not going to say, give me, unlike an attorney, you call them up for advice and it's how much per minute, right?
That'll cost you $800 to ask a question.
To ask a question. What's your second question?
So, keep them coming. Keep those questions coming.
So that's what we do, and I think it's lots of options, and that's why we put this show on, is so people can actually hear about different options, and if they have questions, we're here for you.
That's a good point. And I actually researched this last night, so for fun, and this is something, again, if a client called, if we don't know, we know where to go, but it's actually what's adjusted to regular adjusted gross income. MAGI adds 3 things: untaxed foreign income, non-taxable Social Security. So the Social Security piece, so a lot of times the government giveth and then taketh away. So it's non-taxable, but then you got to add back in, and then tax-exempt interest. So if you buy a muni bond, it's like you think that's federally tax-exempt, but it's added back in to MAGI. So these are kind of the things that, like you said, we'll help guide you through it. We don't want to get overcomplicated, but what do you think, Austin Jacks?
Tax code's really easy to understand.
Well, I think I saw a picture once of the number of pages of tax law and tax code.
Is it?
I don't remember the total pages, but it was piled up next to Kareem Abdul-Jabbar.
Oh, really? Was he standing up?
It was 7 feet tall.
No.
That's how many pages this picture showed of all the tax pages. If you just pile them up, he was standing there leaning on it.
Way.
And he's 7 feet.
Oh, you got to send me a picture of that.
I'm sure we can Google it these days.
We can Google it and we'll post it.
Just another tip for our friends.
All right, so we're coming close to the end of the episode. Mitch, you want to give us a quick update on this week's market with a Minute with Mitch?
1 minute with Mitch.
Well, a lot of things coming out. The rate cuts just this morning, April 30th. ECI came out, which is numbers based on employees and benefits and salary. The salary portion kind of stayed the same, But what really drove it up to a scary point is benefits have gone up in the cost. So right now, the number that came out was 1.2. They were expecting 1.1. 1.2 hasn't been this high, I believe, since the first quarter of 2023. So that put another little stick in is the Fed going to lower interest rates again. Right now, of course, June, I think, is now down to 0. December has dropped significantly. December now is about a 50-50 toss-up. It was in the high 80s prior to that we'd have a cut. August, we do have a chance, but it's a lot lower than 50%. And that's a problem right now. I think we just need to lower it a little, at least to start and see what's going to happen. But this morning's numbers weren't that exciting, so 1.12 did not help us this morning.
Yeah.
And I believe this week we have the more job numbers coming out, so we'll see where that brings us. But right now, probably not seeing a rate cut, which is good for people on fixed income because high-yield savings, your information you gave out, and T-bills are probably not going down right now.
Which is good. But, just to add to that, surprisingly, when you had earnings come out with Microsoft and you had earnings come out for Google, they were positive. So,
Very positive.
That big tech, Magnificent Seven got a little beat up. And then you had, those are two big companies. I guess Google now has just breached $2 trillion of asset value. You've got Microsoft at $3 trillion of asset value. And then Apple, I think, reports today or tomorrow. So hopefully there's a little momentum because at the end of the day, inflation's here. It looks like it's going to be stickier and longer. But at the end of the day, if companies are making money and earnings are strong, that could continue to stimulate the market. So we have to just kind of wait and see.
Corporate profits are still very, very, very good.
And that impacts results. So.
And that's why, the market did have a little hiccup over the last 3 weeks. But we had one of the greatest first quarters in history.
Right.
According to Bloomberg, I think the S&P was up through March 31st for the first quarter. I think it was up about 10.2%.
Yeah,
10.2.
Think about that. It's a good run.
It's an amazing run. We like to say, hey, if we can get 7% annualized, that's a good number.
Good, yeah.
These numbers coming out are just over the top.
Hope
Slight
it's sustainable.
Pullback.
We want it to be sustainable.
Yep, and so that's where we are with
Amazing.
everything.
Thank you, Mitch.
1 minute with Mitch and Frank.
We're going to wrap up the episode here today. Make sure to tune in next week. We have a very, very, very special guest, a very close friend of mine and my family's, and you're not going to want to miss it. And remember, folks, the secret to wealth is not what you earn, it's what you keep. Happy days, everybody.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed. If you have a question for the guys, email podcast@bestadvicepodcastguys.com.